All right, what up, guys? Happy Sunday, everybody. So we got about 23 more hours until the market opens. So I'm counting down. I don't know about you guys, but all I wanted to do today was get you guys together and let's just talk a little bit about option selling. It's something that we're going to be covering here in the current course in the group, but I figured the more that we can kind of get together and just talk about, kind of one piece of the puzzle as far as it comes to option selling at a time, that you guys are really going to grasp it much better versus me just throwing everything at you at once and having to work your way through. So really what I want to talk about today is just kind of, the thought process and the reasoning behind selling options versus buying options, the major differences between the two, what works in your favor when you're selling options, which is typically something that works against you. And then I'll show you guys a little bit of, the risk reward, a few different ideas of the spreads, just to kind of continue to, build that foundation. So jump into a few things here. Now, what I want you guys to do, all right, is tell me in the chat. All right, I'm going to offer you guys two bets. The first bet here is I'll offer you guys $100 if you can throw the dart, at a dartboard and hit a bullseye. The second bet I'm going to offer you guys is that I'm going to give you $100 if you land the dart anywhere on the board. So which bet would you guys rather me make with you? Bet one or bet two? If you're going to make $100, which bet would you rather take here? Right. Another bet, right? For you athletes out there, I'll bet you $100 that you're going to make a free throw, or I'll offer you a $100 bet where I'm going to pay you that 100 as long as you don't toss up an air ball. So again, which would you guys rather have here if you're trying to make that $100? Bet one or bet two? And then the same thing, right? Talk about the Lakers a little bit more, even though I'm a Celtics fan. You're a Lakers fan, right? I'll bet you $100 the Lakers win. Say they're playing the Utah Jazz, right? Bet you $100 they win, or I'll offer you a $100 bet where I'm paying you that 100 as long as the Lakers don't lose by 10. If you're a Lakers fan, you're confident they're going to get the W. Which bet would you rather take there? Bet one or bet two? Right, y'all see where this is going, right? Every one of these bets, the first bet requires, a very specific outcome. The second option gives you a much higher probability of making that, right? So what we're looking for really with option selling is these high probability bets. So for all of those bets, the first option requires one specific outcome for you to walk away with that hundo. But the second option for each bet, it allows for multiple different outcomes that still are going to result in you making 100. Instead of having to hit a bullseye, you just got to get the dart on the freaking board, right? Instead of nailing the free throw, you just can't toss up an air ball. Instead of your team winning, they just can't lose by 10. So when we sell options, essentially with our trades is that we're taking bet number two. So when we talk about selling options versus buying options, right? When we buy options, we need that option to gain value in order for us to make profit. And for an option to gain value, whether it's a call or a put, the stock that it's attached to has to move in its direction, right? If you buy calls, for that call to gain value, the stock has to move higher. There's no choice. If you buy a put, the stock has to move lower for your put to gain value. So in other words, when you buy an option, you're taking a directional option trade, and it's kind of common sense, right? Obviously, but you take a step back and break it down a bit, begin to realize a few things. There's only one move that's going to result in you making a profit, right? You buy a call and when you buy a put, there's only one thing that can happen with that stock leading into expiration that it's going to make that option gain value, giving you a profit. But when we sell options, we're on the total other side of the fence here, guys, right? When we sell an option at $3, we want that option to lose value in order for us to make a profit. So just like you would short a stock, you go short Beyond Meat, whatever, we're shorting these options. So as many of you guys, me included, have learned the hard way, options lose value pretty easy, right? We've all gotten our asses kicked enough to know that it doesn't take much for an option to lose value. In fact, it doesn't take much for these options we sometimes jump into to lose 25, 50% of their value just like that. And then the other thing to consider, guys, is that options lose value from other factors that have nothing to do with the direction of the stock itself, right? And that's known as premium decay. So when you sell an option, a stock can go up, down, sideways, and really do whatever. And the option you sold can still lose most, if not all of its value. So really, it's bet number two, where a bunch of different outcomes in that given trade in the direction of that stock can result in you making a profit when you sell an option. But when you buy a call or you buy a put, the stock simply has to do what you think it's going to do. So you need to be right. When we think about the way that options work and you kind of reflect a little bit on, I'm guessing a lot of the difficulty you guys have experienced, like I have, where we're buying these options directionally, and when things work, and again, this is the allure of trading options like that, when things work, it's so easy to grow an account quickly. But when things don't work, it's tough to control the damage that comes in. So there's so many factors that go into options that make buying them very, very difficult. But those same things make selling them a really sweet game. So we are going to talk a bit more about these things in finer detail, guys, in the course videos. But premium decay, it's typically something that, gives you frustration and gives you headaches and just kind of whoops your ass when you're buying these options. But as an option seller, premium decay is going to be your new best friend. So as we know, options, especially those out the money calls, those out the money puts, they just simply lose value as time passes and expiration nears. And that's known as premium decay. The thing to keep in mind here, guys, is that out the money calls and out the money puts are designed to expire worthless. And if that option, whether it's a call or put, is still out the money come expiration, it is going to be worthless. It's just the way that options work. So the premium decay here works in our favor as expiration approaches, right? Like right now, I sold 294.50 puts on the S&P 500. I did that on Wednesday. Now, the market hasn't necessarily ripped in my favor, but what's happening really? It's looking more and more likely as the days roll by that 294.50 put is going to expire worthless. So even though the market isn't rallying to the upside, the put that I sold there is already losing value just from that premium decay. So as an option seller, guys, right, there's two different sides to this options world. You got the people who jumping into these lotto calls, right? They're buying the out the money calls. You got people buying those out the money puts, right? Those quote unquote lotto options, those lotto plays. But as an option seller, you're kind of the guy behind the counter selling those lottery tickets. So the way that I'm looking at my trading is that I'll sell you the dream and I'll just sit there and collect that premium as the option that for whatever reason you wanted to buy approaches its inevitable death, which is going to zero. So when you sell out the money options, essentially we're shorting an options contract that's heading towards zero unless that option actually goes in the money by expiration. And that is just how options work. Options lose value as expiration approaches and ultimately are just going to simply expire worthless if still out the money come expiration and come that close. So really, when you kind of remove yourself a bit from, the charts and the price action, it oftentimes isn't so much, guys, a matter of which direction the stock or the market moves. Really what matters is that it just doesn't cross the strike of your call or the strike of your put, and if that takes place, you collect that paycheck. So give you guys, a bit of an idea what I mean by this. You've already seen the trade that I took here on Wednesday, right? So market dips a little bit on Tuesday. We open up down here on Wednesday. And right now, I'm of the thought process that the market is going to move higher, right? Based upon a few big picture things that we don't got to take time discussing right now, I think the market is going to move higher here. So what typically a trader would do here, right, is they're going to jump into a call. So you can buy a call right here when the market's at, 299, whatever. Now, here's the thing. So far, this is working, right? But as we know, guys, when you buy a call, there's only one move moving forward that's going to result in you making a profit, right? So the market has to move forward. Otherwise, that call is just steadily losing value with every day and every hour that passes heading into expiration. So far, right, you have a decent return on your hands. The market is popped. But when you jump into that call, this has to happen. And to the extent that doesn't happen, or to the extent that this move to the upside here begins to fade off, the option that you bought here is in trouble, right? You can't afford anything less than a move to the upside. So if you're looking for a week-long trade, a month-long trade, really whatever the time frame is, you can't afford to be wrong. And we've all lived through this, guys. We get a good-looking entry. The stock just simply comes against us a little bit, right? How often are we getting tossed around on the options we're buying on, price action that's literally irrelevant? These little dips, these little fades, these little bounces against us that are nothing when you take into consideration, the price action of the stock itself, but it's enough to, really wreak havoc on the options that we're buying. So those are the emotions, and those are kind of, the factors that I'm not looking for in my trading. So what I did here instead, and again, I think the market's moving forward. I think the Lakers are going to win, so I should be pretty damn confident that the Lakers aren't going to lose by 10 points. So instead of buying a call here as an option seller, I sold puts down here at 29.45. And like we just discussed, guys, these are out the money puts. These out the money puts expire this coming Friday. And since the market hasn't collapsed and dropped to that level, all that's happened here, really regardless of the fact that the market has moved higher here, just simply on premium decay alone, all that's happened here over the past few days with that put I sold is that it's steadily losing value, right? Tomorrow is Monday. We're 4 or 5 days away from that thing hitting its death, right? Expiring worthless, unless the market completely turns around, drops below the 15, drops below the 50, and drops below that key 295 level. So if we take a look at the trade I took, right, on that little drop there Wednesday morning, I'm selling 7 contracts of the 29.45 put, and as protection. We'll talk more about what I mean by protection in the course, right? But you never sell options naked. So as protection, just in case these things erupt, I bought 7 of the 29.35 puts. So think about, the structure of these options, guys, right? I'm selling these 29.45s here on Wednesday about a week before expiration. Now, it doesn't really matter if the market moves higher. It could go sideways. It could go up a lot. It could go up a little bit. It could even come down pretty aggressively. But come next Friday, these puts that I shorted at $9.50, they're going to zero. And so are the puts that I bought for protection. So if that takes place, I walk away with $1,000 difference between those two options, right? And that's what makes a credit spread. I'm going to collect $6,600 plus of credit from the options that I sold. So I collect all that premium, right? So whoever wants to buy that lottery put, right, on Wednesday morning, whoever actually felt inclined to buy a put way down here on the market, I'm going to sell that guy that dream every day long, because now he's just getting his ass handed to him, and I'm sitting back and riding this thing from 950 all the way to zero. So the beauty of this, guys, is that when I put this trade on Wednesday, I don't really, I have nothing to gain by sitting here and staring at the charts anymore. We all know damn well when you buy a call, you might want to sit there for a little bit, right? Unless you're going to set a hard stop loss, you might want to pay attention, right? We know when we hold calls overnight, we're checking the pre-market price action as soon as we wake up. And we know, guys, right? The slightest moves against us when we buy an option, they can hurt that option that we bought, right? And this gets worse and worse as you start going out the money, because now you have premium decay and a bunch of other factors working against you, the same factors that are working in your favor when you're the guy selling options. So I put this trade on here on Wednesday. I'm sleeping good that night, right? I'm knowing that, all right, if we wake up tomorrow and we gap down to, 29.90, or we gap down to 29.80. I mean, fuck, guys, even if we gap down to 29.60, I'm not getting destroyed, right? I can completely afford that. So no longer, when you're taking these kinds of trades and you're selling options, no longer are you, quote unquote, emotionally attached to every little tick and every little piece of price action, that the stock, or in this example, the market is making. And that's no way to live, right? I've been there. I've made a lot of money trading in that fashion, but at the end of the day, it's not a good quality life. When your emotions, your ability to be happy, your ability to enjoy shit is dictated by, this daily noise, that daily price action. So I'm putting this trade on Wednesday, and then, I'm out of here, man. I'm probably shooting hoops or doing something else. And the market can move higher, and I got that $1,000 coming in, right? The market can explode and I'm making that $1,000 quick. But it could also just steadily climb over the next few days, and that put's still going to zero, right? The market could do nothing and just flatline for the next few days, but that put is still going to zero, right? Now I could be dead wrong. And again, we're removing the need here to be right, guys. I could be dead wrong, and the market could actually pull back over the next 3, 4, 5 days. But as long as we're not below 29.45, those puts are going to zero, and I'm going to make that $1,000. So now instead of me relying on being right, relying on the market doing exactly what I think it's going to do, the market can really do whatever it wants, right? And I don't care what it does. To be honest with you guys, I'm really hoping the market drops here, because I'm still going to make my $1,000 in the puts I shorted down here. And I would love, right? Like, I'm frisky for this. I would love a little drop here in the market so I can come in again and start selling the shit out of these out the money puts, right? And I'm going to keep doing this here, just like I did last week, just like I did again here this most recent week, until the market ends up dropping below either those key moving averages or a few other things take place. But I can afford here to be dead wrong. And that brings a lot of peace of mind, at least to me, guys, as a trader, right? I'm going to bed and I'm not really stressing, checking the pre-market quotes. Think about, and of course, could the market drop below 29.45 here before next Friday? Absolutely, right? Anything could happen. But I'd rather that be what has to happen, right? A complete turnaround, a complete blowout, right? Blow through the 15, blow through the 50, blow through the 295 level, right? If that's what it takes for me to not make $1,000, I'm going to do that every single time, guys, right? If that's what it takes for me to take an L on a trade, I like that over the alternative of buying a call. The market dips 0.25% the next day, and your call is down 30, 40%. That's what I'm trying to avoid here, right? So the cool thing about these is that when you're taking these spreads, you can step back, kind of go focus on other things. And unless the market is rapidly heading towards the option you sold, every day that passes, guys, right, that position is gaining profits. I'm putting this position on here on Wednesday. And right, I think we can all agree that the market hasn't necessarily like ripped, right? I put this on Wednesday morning, and sure, we've made a decent little bounce to the upside, but nothing crazy. But really what's happened here is that Wednesday, Thursday, and Friday have passed. And with every day that passed there, we're getting closer to expiration. And what's happening here to this put that I sold at 29.45 is that with every day that passes and the market isn't rapidly heading towards it, it's getting closer to that death, right? So my max gain here is 1,000 if these things go to zero. But after putting this trade on Wednesday and kind of just getting out of here, right, you can see I've already collected about $750 of that potential $1,000 profit. So again, I'm making money here, guys, not so much because I call the direction, but because I'm exploiting the way that options work, right? I'm pretty much selling lottery tickets. The people who really make good money in the lottery game are the guys behind the counter at your local convenience store who are selling you fuckers these tickets every single day, every hour of every day of every week. That's what I'm doing here. If anybody wants to jump in here when the market dips a little bit and start buying these puts way out the money, puts that if you looked at the options chain, had an 80 to 85% chance of expiring worthless, right? I'm going to sell those to you every single time. And that's the high probability side, guys, of selling options. Now let's take a quick look before we wrap it up. Is something like NVIDIA, and I'll give you guys an example of, how you can make your swing trading a lot easier with selling options versus buying options. So for NVIDIA itself, we got a big move here on Friday, and for the first time in a while, right? For the first time, and we'll call it almost a year, we see the stock closing back above 200. So there's surely a lot of people right now that NVIDIA is broken above 200, looking for this thing to make a nice strong rally to the upside, right? And it easily could. The volume's starting to build. That's a big level of resistance, and we finally cleared it. But as we discussed, and as you guys understand, if you buy a call here, what does NVIDIA have to do for you to make a single dollar, right? It has to continue to move to the upside. And then for you reckless individuals who are buying crazy out the money options at 220, freaking 230, well, then it has to make a big move, right? So this might be a good looking setup. There might be some edge behind it because the volume's building, because we've cleared a key level, but you can make the potential trade here, right? You can make the potential swing trade opportunity much more of a high probability trade by just simply selling options. So to give you guys a bit of an example of what I mean here, we're above 200, and the whole thought process, right, is that NVIDIA is finally above this key level of 200. It should be able to move higher now, right? So essentially, we're kind of wrong on this idea as soon as this thing drops back below 200, right? But again, I want to get a good chance here to swing NVIDIA, potentially catch this move over 200, right? Catch a nice move to the upside, but I still want to sleep at night, right? I don't want to wake up tomorrow morning, this thing's dropping back below 200, and I'm getting, I'm getting bent the hell over. So the alternative here, instead of buying calls, would be to sell puts, right? So I'll give you guys an example. We're going to go look at NVIDIA here on the options chain, right? And for a swing trade, guys, right, with spreads, the deal gets a little bit sweeter the more, time you give yourself. So we're going to look at the December 6 options here, but keep in mind, we're going to sell puts for December 6 expiration. But if NVIDIA does, in fact, begin to rally like crazy here, it doesn't matter that those puts expire in December. They're still going to get wrecked. You're still going to collect your profits. So when you go further out to expiration, it doesn't necessarily mean you're going to have to hold this to get what you're looking for. But just to display kind of the thought process behind it, broke above 200 here. You think this thing's going to move higher. Instead of buying some calls and having to be right, and deal with that volatility, let's sell some out the money puts instead. So we're going to go to December 6 expiration. And what we're going to do here, guys, right? And this is an example for those of you new to spreads, those of you with smaller accounts and new to options. We're going to sell puts all the way below the current price. So we're trading at 204.50 right now, and we're going to sell puts down here at 185. Right? And as protection, we're going to buy puts a few strikes out even further at 180. And then we go look at our chart, guys, and here's how this trade works. We're thinking this thing's above 200 now. It should move higher. You think the Lakers are going to win? You should be confident they aren't going to lose by 10. You think NVIDIA is going to make a strong move above 200? Then you should be even more confident that it isn't going to drop quickly back below 185. So this is a way, guys, here, right? And we're looking at a smaller position example, but that's about a 25% return, right? High probability options trading, you're not going to double your money, right? You're not going to get a 10 bagger, but you can get incredibly low stress, very high probability, 20, 30, sometimes 50% returns without having to sit here and babysit this shit. So we think NVIDIA is moving higher. We think it's going to make a move above 200. We're not trying to get wrapped up in the game of the calls. So we're going to sell puts, guys, all the way down here at 185. Now with NVIDIA trading right now at 204.50, and we're selling puts down there at 185, this thing has to drop, we'll call it 10%, for us to not make our max profit. Now, if you bought calls there on Friday, what does NVIDIA have to do here, guys, for you to make money? You got to be right. It has to move higher. And it might move higher over the course of 4, 5, 6 weeks, but there could be a lot of volatility, right? There could be plenty of day-to-day price action and noise that just knocks you out of that position. Where I'm going to be is the dude who's down here, all the way down here at 185, and I'm chilling. And instead of NVIDIA having to move higher for me to make money, guys, now what has to happen, right? Or now rather what could happen? If NVIDIA does move higher, I'm still making my max profit, right? And I'll make it even quicker. If NVIDIA just kind of sits sideways here, I'm going to make my max profit. I could be dead wrong, right? I'm thinking this thing's going to move over 200. It could drop right back below 200. It could drop a good 10 points. And I'm still going to make my max profit, right? It could just completely turn around, come back down here to these lows, and I'm still making my max profit. With this trade right here, it doesn't even matter so much what NVIDIA does moving forward. Now, you're taking the trade because of the bigger picture thought process. breakout setup. We've got increasing volume. We've got crazy options flow into the call side, right? There's edge behind the trade idea itself. Here's a really high probability way to take it. Here's a way to take that trade opportunity in NVIDIA where you can still make your money even if you're dead wrong. So again, if you're a Lakers fan and you think the Lakers are going to win, then you should be really confident that they're not going to lose by 10. If you're looking at NVIDIA here and you're considering a swing trade because it's moving above 200 and you're confident that that's going to take place, right? You're confident enough to jump into a call that you know isn't going to gain value unless you're right, then what the hell? You should be crazy confident that this thing's not going to drop 10% over the next few weeks, right? So you guys get where I'm coming from? We're more so just exploiting the way that options work without relying on being right? Without relying on things that are literally out of our control, without having to sit here and babysit these positions. And really, the biggest thing for me is that I'm just not emotionally attached to that day-to-day price action. I'll give you guys a good example of a trade I took recently where I most definitely would have gotten stopped out if I had bought in a put versus selling calls. So I'm looking at shop here early last week. I know a handful of you guys have already seen the videos on this trade, but we'll go over it real quick. So I'm looking at shop here. What is that? The 21st, that Monday morning, right? So I'm looking at shop here Monday morning, guys, right? Now, this thing's gotten beaten down here. And every bounce that it had heading into Monday morning, they just sold the shit out of it, right? They sold the crap out of it. So I'm sitting here Monday morning. This thing's popping up at the open. I think it was up, 2%, something like that. And I'm calling BS, right? I'm calling, all right, this bounce ain't gonna last. Now, if I, right here, guys, right, I took that position when this thing was at about 321. Now, if I jumped into puts here, right, because I'm thinking this thing's gonna move lower. If I jumped into puts here Monday morning when shop was at 321, I'm very quickly dead wrong, right? And very quickly, a handful of options that I may have bought there are down 30, 40, 50 to 60%, right? The thing comes another 1.5% against you. So now think about all the emotions in a decision process, right? With decision making that comes from that little piss ass move against you, right? You're down 50% now on your out the money put. What do? Right? Do you cut the loss? Now it's first thing Monday morning. You just got bent over real quick. Now you're frustrated. Do you jump into calls, right, to try to hedge it? All those decisions, and then the thing comes right back into the close. Now, what's even more frustrating about that is that on paper, right, the put you jumped into here this morning should pretty much be back at the same value, but that ain't how it works, right? That move against those puts already beat them down a bit too much. They didn't regain that full value. Then the next morning, this thing gaps up again. And now once again, if you held this, your puts are quickly coming against you. Now they're losing even more value because they're not heading towards that strike price. Now, neither of those were really big bounces in shop, right? If you looked at a daily chart, you can't even see this, but it's enough to bring on all kinds of decision making, to bring on all kinds of frustration, and it's enough to do a lot of damage to the options that we're buying. But as you guys are probably guessing, that's not what I did here. What I did here instead was I'm selling calls as this thing's bouncing up here at 340. So things trading at 321. I think it's going to move lower. I'm selling calls up here at 340. Now, initially, I'm quote unquote dead wrong, right? I'm taking this position at 321. I'm thinking the stock's ready to fade. I'm dead wrong. It comes up another 1.5%, but guess what? Didn't mean anything to me. I'm chilling. I'm all the way up here. And those calls that I shorted, they really ain't gaining much value on that pop anyway. They're still 5-6% above the current price. Then things fade, right? And my position's in the green. I'm chilling. The next morning, this thing gaps up again. And what am I doing once again? Not caring. Because I am still in here, those calls sold a good 5-6% above the current price. So in other words, guys, two moves took place here in shop that would cause a lot of problems and a lot of frustration and damage to the individual who bought an option looking for this thing to move lower. But for me, for my seat, for the guy selling the options in the opposite direction, that didn't bring on any emotion at all, right? I'm literally not even paying attention. That's meaningless to me, right? Because we're not going towards 340. Next morning, this thing pops. Guess what? I don't care. Because as long as we're below 340, I'm making that money. And I still got all that cushion. So I'm able to ignore those first two little shakeout attempts. And then, like often happens, guys, the move takes place. So how many times does this happen to you guys? Because it used to happen to me a lot when I'd be buying options, right? I'm jumping into these aggressive options and the thing starts to go against me, and I'm not trying to sit there and eat that 50% loss. So I'm getting stopped out, and then a day later, an hour later, whatever, the exact move that I was looking for and that a lot of people were looking for takes place. But the moves we're looking for aren't always going to be as simple as you take an entry and that thing just immediately works. So you guys get where I'm coming from. As a buyer of options, there's just so many, different elements built in that really are working against you, right? Premium, decay, theta, bunch of other shit. But those things on the other side of the fence, right? The option selling side, those are working in your favor. You remove a lot of the emotions, you remove the need to be right. And for me, the best part about these spreads is that because I found them to be so consistent, I'm able to progressively get bigger slowly, but I'm getting bigger with every week that passes. The directional side of options trading can be tough because as we get bigger in position sizing, what that often means is, you're taking that quick 30, 40, 50% hit against you, it just becomes a bigger and bigger number, right? And, we can talk about controlling emotions all we want, but all I know is that as I tried to get bigger and as I'm putting $10,000, $12,000 into calls and puts, it's kind of freaking mayhem, right? What can happen when the stock itself barely goes against you? Now, everybody's different, guys. Some people are going to have stomachs for that. Some people are going to be completely fine with, having a stock rip against them and watching their P&L just get crushed, right? For me, I understand how the market moves. I understand, the cycles the market goes through. I understand the supply and demand, the tape. I understand the few things that actually matter, but most importantly, I understand how options work. So now that I'm an options seller dominantly, right? 90% of my trades are selling options. Now now and only now am I realizing just how hard it can be to make consistent money when you're just flat out buying the options. And the only reason I know this now is because I'm the dude selling you people those crazy lotto options. So does this all make sense, guys? You got any questions or anything we could cover on this?